Good morning, everybody. It's still morning here in LA. Dr. K and I just arrived in from the Money Show in Las Vegas, and this morning we had an 8:30 flight coming out of Las Vegas Pacific time, and it got canceled, so we ended up on a 9:40 flight. And it figures that the market would start to run into some trouble right at about the time that we were getting on to the replacement flight. But the first time we haven't traveled by private jet, and of course we pay for it because we had a canceled flight. In any case, just want to make sure everybody can hear me okay. How's it going out there? Good, okay. You can see what's going on here. You know, we haven't had a chance really to go through a lot of screens. We were looking at some things earlier when we were sitting in the airport, which is to me just such a ridiculous concept, having to sit there like a cow or some part of a herd sitting there. It's like that was just foreign to me. Sorry I'm whining about it. You guys probably all think I'm stupid, but I'm just used to jumping on the jet and going, you know, not wasting time. And I'd have to say that what it would have cost to take a private jet into Las Vegas and out real quickly is probably less, quite a bit less than what I might have made trading some of this. But in any case, what's going on here with the NASDAQ right now is you're breaking the 2,900 level. We've already talked about that as being a critical support level, but it also sets up the potential for an undercut and a rally. And I know we've had a lot of questions about, you know, will the Facebook IPO, you know, would you buy it? Would you, is it going to make the market rally? Will it start a new bull market? It's like, you know, I would say the Facebook IPO is probably going to be about as irrelevant as the Baidu IPO in 2005 and probably as irrelevant as the LinkedIn IPO last year, because I think a lot of the hype is already in it. If you recall, when Google came public, there was a lot of skepticism. I actually remember doing, when I was at O'Neill and Company, doing a interview with the San Jose Mercury News about what my thoughts were about the Google IPO, and most of the verbiage regarding that IPO was negative, and a lot of people were saying Google was overvalued, and why did they go do a Dutch auction on the IPO, if any of you remember that. You know, there's skepticism, but with Facebook it seems like there's huge expectations, so I would think that a lot of those expectations might be dashed. Now, there may be some hype that causes a bounce in the market, and I think if you're undercutting these lows, volume is picking up today, right, Dr. K?
It is on both exchanges. It's about 70% on the S&P, about 14% above normal on the NASDAQ.
Yeah, so you know, you're picking up volume, you're breaking support. Everybody sees that. It wouldn't surprise me if maybe you had a little blip to the upside on Facebook, and that's a shortable blip, but I don't know. We'll see what happens. Our general view has been that the market's subject to a lot of news manipulation. I think this morning there was news that Merkel, Germany's prime minister, or whatever they call her, Merkel, was cooing with Holland, the new guy in France, and the market was up 80-something points on the Dow. I saw that earlier this morning. And it seems like news like that is used to rally the market. Yesterday, so the market did the same thing. They're holding it up all day, and then they let it go at the end of the day, and it blows apart. It seems like today they're coming after a little sooner, and it's starting to break in earnest. And I think part of what's leading this probably is you see Apple is coming off, and it's undercut that 555 low of its base. You got to see it up here on my screen. These are all the stocks I've been targeting on the short side, just trading them, and we talked about some of these last week, and some of them are actionable. And I know some people have also asked why we're not putting out a bunch of short sale setups, and it's primarily because I think there's a lot of risk on the short side here, and I'm not comfortable telling somebody to short this or that, XYZ or ZYX or whatever, without at least the opportunity to explain my thinking on it a little more fully, because I think it's very dynamic right now, and I think you have to be nimble and opportunistic in terms of your entry points. And I also think you're subject to these bizarre movements in the market that can have you on the wrong side if you're short very quickly. And so I'm just not comfortable putting those out right now. I think you're in a bizarre sort of state where you're going to see a lot of news coming out. I think the market's telling you that something is up and something is going to snap here. And we're going to see probably a lot of volatility. So we'll see how this goes. But I'm comfortable talking about with you guys on the webinars. That's part of the reason we do this, so we can give you a little closer view into what we're looking at, and also have the opportunity to explain things a little more fully. I don't really like just saying, oh, do this in a little short paragraph on email, because a lot of times it's much more subtle than that, and I think in particular in this environment it's very subtle. Anyways, we've got some people Yeah, Dr. K is not muted. He's actually sitting next to me, but he's kind of sitting away from the microphone here. I'll have him come in. Anyways, so let's just continue what we're looking at here. You're breaking support. I'm kind of looking for maybe a little move down and a one more jack back up into that area, and then you're heading for the 200-day moving average. That's what it looks like, right, Dr. K? Would you agree with that on the NASDAQ?
Yeah, we've got, I mean, that 2,900 level is interesting. We were giving a talk in Vegas, and it broke through the 2,900 level on some volume. Apple as well, Apple and all these stocks. Market took these stocks right with it, and then instead of slipping and sliding well below 2,900, it gained traction again. So it's not a clear market environment in terms of what's going on a day-to-day basis, but the model remains on a sell because we are in a downtrend. So it'll maintain that position until the market signals otherwise. Right now, things don't look good. I mean, look at all that price volume action, lots of distribution days, and Apple looking like, you know, it's where Apple goes, so goes the market, and Apple looks like it's got a worm in it. So we'll see.
It's got a few worms in it, I think, but that's just my view on that. Let's see. I gotta switch some. Let's go to a daily chart here. Let's pull that out. So let's take a look at some of these stocks. Obviously, Priceline. We've talked about this, but Priceline broke the 10-day, violated the 10-day moving average here. So that was really a sell signal back then. Of course, it turns around and goes higher, but it fails. Double top type formation. Now you violated the 50-day moving average. You're on top of here. It looks like you're in a position to try and bounce, but you don't know how bad this is going to get, and it could get a lot worse, perhaps, over the coming days. But I still think you're in a potentially very volatile market here, and I don't think that you necessarily have to be short if you're willing to take that risk and you have a high enough risk profile in terms of your own preferences. I think you can do that. I don't have a problem with just sitting in cash and just waiting to see how things pan out, because I think you're seeing a lot of poo-poo about to hit the fan, and that could just splatter all over the place, and you really don't know whether you're going to have something blow up in your face. On the short side, I've tended to just be day trading and trying to be opportunistic on some of these stocks. So, for example, even Apple, I felt, let me put a moving average in here. And now don't forget to start piling up your questions for us so we can talk about some stocks. I have some that people have already asked us about. Let's see, is this right? Let's see, there we go. Yeah, so with Apple, wait, what am I doing? I said I was putting a moving average. We're going to put a 65-day exponential moving average on here. We'll color it black. Whoops. And let's put that in. What I was looking at is, you guys know I use the 65-day exponential sometimes on the short side if I think the stock is obeying it or showing that it is significant in the pattern or has meaning. Here you can see it comes through the 50-day moving average, holds the 65-day. Now you break, bounce off the 65-day exponential, and you rally. So this little weak rally I kind of hit, and it's coming down. But the bad news is I covered my short yesterday at the close because it undercut this 555 low. I thought it might lead to another little, just kind of little reaction bounce. You still could get that. I mean, you're on top of this pattern, but I don't think this has much support for the stock. Now, everybody expects Apple is going to 1,000, and of course we talked about this, that when everybody thinks a stock is going somewhere much, much higher, it probably isn't. The crowd is almost always wrong, if not always. And I think the crowd on Apple loves Apple, but Apple does not love the crowd, and you're seeing that in the price action because this turkey is breaking down, and it's coming down with not a lot of selling volume. And so I find that a little bit problematic. In terms of the fact that you're not seeing any buyers step in. I mean, I guess it means you could see a big volume spike on the upside, push it back up if there isn't heavy selling, but it seems like everybody who's bought the stock is in the stock, so it doesn't take much selling to knock it down. That's a stock that's in a weak position, okay? So I think that if I was long this stock, I probably would have sold it a long time ago. Well, I was long it at one time and sold it a long time ago, but I definitely would have been out of it, here. And actually, I was shorting into this move, just doing these little tactical shorts. Here, I think you're starting to set up maybe in some sort of short-term head and shoulders on the daily, but on the weekly chart, not necessarily so clear. Here's the S&P. You can see it's also breaking support. Let's get that out of there. We don't need it. Where did all my charts go? Let's see. I think I need to pull up another chart. Let's go here. default chart. Go to a weekly chart. There we go. And pull up Apple again. So it's not really head and shoulders, it's kind of rolling over, and there's a lot of error into this. I don't think you get support here. Were these railroad tracks telling you that the stock was probably, if it goes a little higher, it may tell you though that it's starting to run into some distribution on the way up. Would you call those railroad tracks right there, Dr. K?
Go to that again. See that?
Oh, where did my chart go? Disappeared. I know what the problem is. He's a floater. We got to unfloat him there.
Yeah, those do. They've got above average volume in both cases. Railroad tracks generally occur. This stock's had a huge move. Of course, Apple has. So I would say those would qualify.
Yeah, they look like it, and some pretty high volume.
Yeah.
So that may have been a clue, but really you didn't really need to know much else other than the 10-day moving average violation and now the 50-day moving average violation. And if you're holding the stock thinking that it's a great long-term hold and it's going to 1,000, I think you're dumb. For lack of a better word. And as you all know, I have a very simplistic, vulgar vocabulary, so don't expect too much out of me in that case. So I think if you're holding this stock still, you're dumb. If you think it's a long-term play, you're asking for a lot of trouble. Are you guys adding to your original short on MD himself? Not yet. Then where would you add? I'm not sure what you're talking about. Where would you add? Are we supposed to tell you what we're doing with our own money? I don't. Well, that would also be a violation of our fiduciary duty to our hedge fund clients. So the only place we have placed any trades in inverse ETFs in our hedge fund, which is a much higher risk profile vehicle. And as I said earlier, I don't think that unless you can handle a lot of volatility, because I think it's coming, and you're already seeing these weird swings the last couple, 3 days. I think you really have to be on your toes, and I don't really believe that anybody with a lower risk profile should be trying this. And in fact, it's been a lot of stops and starts over the last few days. And like I said, I don't even have a problem sitting in cash, and I'm probably going to be doing that over the next couple days, waiting for the Facebook IPO, because I think I'm going to cover everything today, because tomorrow I'm flying out to Rhode Island. Anybody out there from Rhode Island? Nope. Nope. Okay. I don't blame you. Actually, it doesn't look like too much to say. Going out there for a wedding. So, but anyways, we'll be trading or watching the market from there. But how you add to, let's say if you bought an inverse ETF position on the market direction model signaling a sell, you have to decide, did you go in full boat? If you went in partially, then you have to decide how you're going to add, and there's no real hard and fast method for doing it. Essentially, the way we would do it, if that's what we were going to do, is we generally pick a percentage that we're up on the position and add, if it's up every 10% or every 5%, we may add the same number of shares of that particular ETF. That's one way to add. So, but you're asking us, did we add? I don't understand what that means, because you really don't understand what trading is about. If you think it's relevant that we added, and that means you should go run out and start adding to your position as well. It all depends on your cost basis, and most of all your risk profile. How heavy do you want to get into this market? And also depends on what parameters you're setting for the way you're going to handle the position in terms of how you add to it. You don't we just willy-nilly just start adding. We use a very specific method, which is just trying to build a cushion and then adding whenever we feel the cushion is sufficient enough to justify adding and not putting ourselves in that much risk. That's how we would approach it. So, but we're not going to tell you what we're doing necessarily. I know I'll talk about some of my stocks in my personal account, but that's another issue altogether. But in any case, I think Apple looks like dog doo-doo. And Priceline, same thing too. Now, some people have speculated whether this is a double bottom in the making, just like Apple. But, look at this on a weekly chart. Does that look like a constructive double bottom? I don't think so. Now, it doesn't mean that the stock can't try and rally and maybe rally back up to the 50-day moving average. You're right on top of this little area. So that's another reason why I think if you're trying to come in hog wild on the short side here, you might be just a hair late, but it's not clear yet. I think I would rather be shorting into some sort of dumb news rally, and I think the best one you might get would be on the Facebook IPO. And I know some people think Facebook is going to be like Google was, or like somebody else mentioned Home Depot. No, that wasn't you, Frank. So I know it was Kausick who's mentioning that. But, you know, Home Depot and Google, it's going to be like that. No, I think it's going to be more like Baidu, because there's so much hype around Baidu and there's so much hype around Facebook that I don't think it's just going to you know, be this hot thing you need to buy on the first day. Maybe it sets up in the base, but I'm going to tell you right now, I'll make a prediction that it's not going to, and it's going to take a lot longer than that. So, but Dr. K is convinced that Facebook has a lot of potential, and you know, you want to comment on Facebook?
Sure. I mean, it's the leader in its space. I always like companies that have that status. Facebook clearly does. So my guess is basically that, you know, where these hot IPOs go, they follow the direction of the market. So no one can predict where the market's going to go. So you got to wait for this Facebook IPO price volume pattern to trace out. If it issues a pocket pivot after constructive price volume action, I'm going to certainly be all over it. I would do the same thing with any other IPO that has you know, that kind of status. So you know, keep in mind eBay in was it September of 1998? It was IPO'd and it lost more than half its value in 2 to 3 weeks because we were in the throes of a bear market. So it doesn't matter how great a stock is, it's going to go the direction of the market, and these IPOs are going to probably multiply the direction by a factor of 2 to 4.
Yeah, so bottom line is you're not going to touch it on the opening, the first day of trading, rather. But I would look at it as potentially setting up a brief news-related rally in the market, just briefly, that you might be able to short into. And it might coincide also with what we're seeing, the NASDAQ undercutting the you know, that 2,900 low. So the volume isn't correct here, but on the daily chart here, you can see what I'm talking about. So that actually does set up the potential for an undercut. You bounce off of support a couple of times, and I know we got some emails wondering why the MDM went to a sell because you're bouncing off support. But yeah, the whole crowd sees that, okay? Everybody has charts. Everybody sees the thing bouncing off of support. But guess what? It keeps, right here you have these two sort of like, they're not real railroad tracks because it's a daily chart, but you can see that this action here is being sold into. It's not support, because if this was support, then you would have probably seen this move higher, and you would have seen better action last Friday when really you churned on higher volume. So, you know, I think you got to look at these charts sometimes and ask yourself, what does everybody see? And I think right now what everybody sees is the breach of 2,900. I think this might set up a little jack to the upside that takes you just above 2,900, and that could be related to the Facebook IPO. And that's one reason why I don't think you need to be aggressive short. If you guys picked on some of the ideas I talked about last week, then you have made money. I know somebody mentions that CF or CF Industries, the big fertilizer stock, was a beautiful trade down to the 200-day moving average, and it's just blowing through the 200-day. So you have one-day bounce. You can put it out again here because it's pretty weak, no volume, and it churns a little bit. So, you know, I cover off to the 200-day, put it out again here, let it break. Now covering in here because you're getting down into this little zone, which you might have some support in this level in here. That's what I'm thinking. The other thing is I'm looking at the position of the index is getting a little bit obvious on the downside. That's what I think. But then, you know, what do I know? F5 is another one that I've been looking at. We talked about that last week, and you can see that F5 found some resistance at the 65-day exponential on last Friday, so I thought it became shortable right there. Now it's blown wide open, but you see how it's undercutting these lows now, and of course this is coinciding with the NASDAQ undercutting 2,900, the S&P undercutting that 1340, 1350 level. So it seems to me that we're in a position to try and rally, with the news flow being what it is. I think there's potential for those sorts of rallies to occur. So I think you have to be, you know, watching your back and just being very nimble on the short side if you're going to do it. So I don't think it's something for people who have a day job unless you're doing real small positions. So let's see here. I'm just going to run through some questions that people are asking, because we don't like anything on the long side. Okay, somebody's asking us if we like, what is this one, LKQX, or what is that, Dr. K?
LKQX, yeah.
Yeah, if this is has all the features of a stock that we would want to buy, and yeah, I mean, it looks okay, but look at earnings are up 24% in the last quarter on this LKQX. Doesn't, let's see, come on, get in on. Okay, there we go. You know, it acts well, but 24% earnings isn't all that great. But the bottom line is you're not in the right market to be going long, so we're not going to buy anything. So if you want to ask us about things on the long side, that's fine, but we're not buying anything on the long side right now. Monster is actually holding the viable gap up, so it's holding in pretty tight. It was interesting on the Southwest flight. I noticed they offer Monster beverages, but they don't provide them as part of their normal free beverage service. They're going to charge you, just like they're going to charge for the alcoholic drinks, which I thought was interesting. So Monster is another drug type of drink. Okay, I like it. Anyways, the thing with Monster to me is the one problem you have is on this big jack on the rumor that Coca-Cola was going to buy them. Now you've created some overhead. I think that's what caused this day on the Bible gap up where it closes at the very low. And so I think that is a problem for the stock just short term in terms of putting some resistance in its face. But on the other hand, if you own the stock, there really is no, is there a reason to sell this thing yet, Dr. K? Although, you know what, if I had owned this going into this day, I would have sold it. I would have just sold into that.
Yeah, that was really a layup because of the, it was a rumor-induced run, and when it gets way up there, you can argue, well, hey, if they even do get bought out, this thing's up what 30% or something, so you might as well sell it up there anyway. And it was a rumor, so it retraced back down. Now where the stock is at, it's holding tight. That's very constructive, especially in a weak market environment. So if you bought on that gap up, you might as well sit tight. Use the 2% porosity, rough rule of thumb to get you out of the position, because if the market really starts to go south, it's going to take most stocks with it, including this one. No matter how good a stock is, that generally will get dragged down with the rest of the market. So where it's at right now, you're in a very good risk-reward profile, meaning that it's only a few percent away from where you would put your sell stop.
Yeah. Go through LinkedIn, of course, always gets a lot of questions. But LinkedIn's, it's a little bit sloppy. Everybody thinks that it's going to get some play from a Facebook IPO, and it's acted well. But you had this Bible gap up. You had 1, 2, the third Bible gap up generally becomes too obvious, and that was the case. It failed. You get this weird pocket pivot here, and that's still holding up roughly. But you'd be using the 50-day moving average as your selling at, and to me that's 10% lower. I don't really like that. So I'm not into buying the stock right now. And as I said before, we're not looking at anything really on the long side. And if anything, we're trying to build our watch list for now, but we don't really see anything that is all that exciting, to tell you the honest truth. So not that we don't always tell you the honest truth, but it's just not there, not happening. So why force it? Can you discuss being nimble? Well, everybody know the old childhood rhyme, Jack be nimble, Jack be quick, Jack jump over the candlestick, and if he didn't, he'd get his butt burned. That's kind of what it means. It means when this market comes in, you have to be alert to what's happening. And it was really nice. I met a guy, we met a fellow that we'd actually seen last year as well, and I won't mention his name, but he is a waiter at Joel Robuchon restaurant, which is a 3 Michelin star restaurant in Las Vegas that supposedly is the fanciest restaurant, or the nicest, best restaurant in all of Las Vegas, maybe even beyond, maybe all of Nevada for that matter. But he actually had been up 73% last year, and when the check came, he covered the check for us, and I thought that was really nice. And if you're out there, Andrew, thank you again for that. That was very gracious of you. But even better, it was really nice to see that somebody has taken some of these tools and actually done a lot better than we have in terms of the percentage returns that he's getting. And he's actually pretty sharp on the short side, but he does understand sort of the cadence of the movements both in the market and how that correlates with stock. So when I'm talking about being nimble, it means understanding where you are in terms of position of the general market. So as I'm talking to you guys here, the NASDAQ breaking 2,900 support, everybody sees that there's a potential for a rally, so you would be ready to bag profits right here if you're short. And I think some of these stocks that we talked about last week have come down reasonable amount to bag some profits right at this level, and then see where things go from here. We'll see if anything really shows up. The only problem is right now you see a lot of late-stage failed bases and not really any head and shoulders patterns. And I would frankly like to see more head and shoulders patterns. Obviously, last year we had Green Mountain Coffee and Netflix were great head and shoulders short patterns, and they both had what you would call shortable gap downs, or SGDs, which is a new thing that we're studying for the short side. But for the most part, you're not seeing many of those. I mean, that's really the problem. So that's what I mean about being nimble right now. Do you have to be able to watch the market charts during the day, right? And then yes, you want to be able to see whether you're coming down to a logical area of support. So let me just, like, for example, and this is where Dr. K and I had a little disagreement a while ago, earlier last month. and it wasn't really a disagreement other than the market direction model goes on a sell when it goes on a sell. Okay, it's primarily objective. It has some components that are discretionary in order to account for those strange anomalies that occur from time to time. But the market direction model went to a sell here, and then that was stopped out up here, I believe. But see here, if you were, and I was shorting off the peak, okay, and the one thing I'll do is I see the NASDAQ bumping on the 50-day moving average, the blue moving average here, I'm covering my shorts. And that's what I'll do, because I find that most of the time when it does that, it will bounce at least once, and then you have a chance to either put them out a little bit higher or just bag profits and step aside and let things develop. You can also see that now you roll up like this and you roll over. Now here's where you're coming after stocks on the short side right in here. Now you might get stopped out if you rally back above here, but this is a good spot to be shorting because you've already breached the 50-day and you've done a 1, 2, and the third time seems more likely to take it further down. I mean, this worked okay on the gap downs, but it held the 65-day exponential and gapped back to the upside. That kind of move will drive you nuts if you're short, and if you're shorting on this move, that can cause some gastronomical problems for you. But I think at this point you have to be aware of the fact that you're now undercutting the 2900 level, and that is a logical area for the market to try and rally. Okay.
Yeah,
so
the model is systematic, but it does incorporate, as I've discussed, it does evolve. So the QE factor is one such factor starting in 2009 that created a new set of rules that the model does follow. And so far, it's been helping the model up until 2012 when we get this sideways trendless action is pretty much the bane of, I think, most trend following models, is because the market can't find its direction, and there's also a bit more manipulation, it seems, going on in this current environment than we've seen in years past. And that manipulation has a name. It's called QE. So QE seems to be a little bit more prevalent in this market.
Manipulation, what is thy name? Okay. Somebody's asked me, do you have levels that you like to trade against on a... Oh, hi, Dave. How you doing? That's who's answering the question here, so it's not somebody walking into my office here. Gil, do you have levels you like to trade against on Netflix short? Levels I like to trade against, or do you mean trying to come after it? Well, here's some of the theories I have on Netflix. I actually started shorting it in here because I thought this is a shortable gap down. I didn't put it out as an SSS or a short sale setup because it's not really the type of setup that I would normally be looking to short. But I thought that it might test the theory out, and sure enough, the thing went lower. But you came down into the 70 level, and you found support here, so you're obviously going to cover that short here, which I did. And then there's some news that an insider bought 200,000 shares. I mean, some people are thinking that means Netflix is going to be bought out or something, but I still don't know who would be dumb enough to buy Netflix. It doesn't really strike me as something that you have to purchase. But yeah, those are the levels I'm trading against. The other thing is you do get some resistance right here, right at the 80 level, and that was resistance in the near term. So I'm not doing anything with this right now. I kind of like F5 on the short side. It's kind of nice, but this is a place to cover. CF, breaking the 200-day again. Whoops, not DR. CF, and but it's to me this looks like you might be ready to bounce a little more sharply, maybe up into the 200-day, and that'd be the next place I'd be looking to short it. As well as CRM, they come out with earnings tomorrow after the close, but look at that's a doggy one and it's rolling over. And I'm going to guess that this thing blows up on earnings and breaks down. So if you're shorting, you have a little cushion. You might chop your position down and put it into something more manageable so that if it does rally 10% on you, you're not going to get creamed. You might take a 1 or 2% loss, but that would just be offset by the gain you might have in the stock already. But to me, this looks like, F5 is getting weak. VMware is another one getting weak. I haven't been playing with that, but all these stocks together are getting weak together, and they all look like giant pods. Here's VMware. This is a big, ugly-looking pod. This is CRM, Salesforce, a big, ugly-looking pod, and you've got F5 is another big, ugly-looking, well, even bigger and uglier-looking pod. And all of these together seem to be breaking down. So I think you have a group play here, so I would keep these on your list as stocks to campaign on the short side, and that's really what I'm doing here. And I'm real short-term on this. I could be intraday, I could be 1 day, 2 day, playing these things. It varies, but I'm not trying to be a hero and take a position and play it for a big move to the downside. I still think if things get real hairy in Europe, I still think, and Dr. K, you would agree that QE3 could show up at any moment, and you're going to wake up in the morning and they're going to be gapping the S&P futures 37 points on you and the NASDAQ 40-something on you in your face. And that's the one thing I think you have to guard against. So another aspect of being nimble and just being on top of things and not getting yourself in a position where if there is an announcement overnight, you're going to get whacked. I tend to want to go in overnight flat. I might have be maybe 30 or 40% short overnight, but I don't really like to sit too heavy. VRX is a stock I think is a short potentially too because this thing broke down huge reversal. We had put this out as a pocket pivot, and that story was over almost as soon as it started because the thing busted the 10-day moving average and just blew through everything on massive volume. You got to be out of that thing. It's a big pod with a huge break on the left side. Now you got a huge volume bust on this side. And yeah, I think it's headed for the 200-day moving average. That one you could have shorted up into the 50-day, but now I think you're probably heading for the 200-day and you're breaking resistance. You could probably try and short it here using the 50 level as a quick stop if the market turns. But keep in mind where the position of the market is. But I think this stock is definitely, to the extent that anything in the market is definite or that you can determine anything like that, I think it is heading for that 200-day moving average, and actually that is the next point of reference. I think any blip to the upside, if you did short and you got stopped down, it kept going a little bit to the 10-day moving average, which is now dropping below all of these moving averages, now the lowest one besides the 200-day. I think that would be definitely shortable. And I was trying to short it up in here, but I couldn't borrow it, so oddly enough. I like this. Being nimble, I'm just trying to figure out my trading personality. You might have multiple trading personalities. So, any thoughts on VMAP being in cash despite MDM and sell? Well, I talked about the VMAPs are the Virtue Selfish Investing Managed Account programs. They've already had to deal with 3 bad signals, so that program is actually down a few percent because of that. It varies by investor, but it's totally normal and within the parameters of the program. But the Managed Accounts program is a much lower risk profile than, say, our fund. And so, like I said, I don't think in right here, right now, you necessarily have to be hog wild short in the market because you're in a position where you could be very volatile. And I think for that sort of risk profile account, that should stay in cash, and that's kind of how we feel about it. Somebody says, thanks for CF, made good dollars. Well, dollars are lousy, but if you made good profits, I hope. Dollars themselves, I question. Let's see. I've been listening to Mike Covell's podcast, Dr. K. Talk to us about the trend followers' performance since November. Oh, do I have to hear that story again? Dr. K.
Yeah.
Somebody's asking. They've been listening to Michael Covell's podcast, and they want to know. Talk to us about the trend followers' performance since November. It's basically sucked because it's a market that has been trendless, and just choppy over the last few months, and even the signals, because we were late getting a buy signal on the MDM earlier this year when the market actually took off, and most trend followers, I think, are just getting chopped up. Is that correct?
I haven't seen the the trend following wizards are these guys tracked by that were interviewed by Jack Schwager and Michael Covell in these sorts of market wizards books, and they have exemplary long-term track records. I don't think I've ever seen such a divergence between what the market's doing in terms of 2012 being an uptrend for the first 3 months, from January through end of March. We were in a nice uptrend. These guys collectively were down, with two of the well, they're all big names, but 2 of the ones interviewed by Michael Covell were both down double digits. I think one guy was off like 17%. So it speaks to the crazy environment that 2012 brings to us. In 2011 was no picnic, but at least there were a couple trends that we were able to catch, and so we were able to well outperform the market. Well, the MDM was able to certainly be up against a market that was pretty flat to down. But 2012 is really, I think, sets a new record.
And I'll just be quite honest, is that we ourselves in those particular programs that use the MDM, we're underperforming the market so far. But we don't have a problem with that because we're used to periods where we might underperform the market or really not be able to grasp it, and we just hang out and wait for the next good signal that we can operate on and make some big money. Last year what helped us mostly was a big 50% up month based on the AGQ move, and a lot of the rest of the year was a lot of sloshing around. So we actually go into detail in the new book going over the trades in 2011 and showing how that happened. And really, in a sense, we're kind of lucky that we were able to catch the AGQ, but it has been a very tough market. And a lot of trend followers are underperforming the market, so are we. But we don't have a problem with that.
Right.
And it's not something we have to hide because it's something we're used to. You just go back to when I first started. Well, around when I first started in the market, I talked about 1995 being down 32% in May, when the market had already been in a bull market for 5 months. Since we're kind of in May now, right? And by the end of the year, I was up over 500%. So the way I look at it, it's like, yeah, sometimes you don't really catch things, especially when it's a little bit strange. But in hindsight, we could have just bought Apple and Monster and gone to sleep. And I know there are some people who've done that, and they've done very well. And I take my hat off to them. I'm going to go to some more questions. Somebody's actually asking. I like this question. It is about using 3 times ETFs. Let's see here. Where did it go? Do you consider any of the other 3x ETF pairs for the MDM, like FAS, FAZ, or ERY, what? ERY, ERY? Is that a pair? Or do TNA and TYH back test best?
Yeah, that's a good question. Essentially, when the model issues a signal, we come up with recommended ETFs based on the performance. So strength begets strength, and weakness begets weakness. So, for instance, FAZ, FAS, that pair there, there were periods where it has been underperforming, for instance, and then if we see open opportunity there, we will recommend those ETFs over, say, the SPY series, S&P 500 related ETFs. What is that? UPRO and SPY.
When you talk about the opportunity, you mean La Ventana de la Oportunidad in Spanish, meaning the window of opportunity? Is that what you're talking about?
Precisely.
I thought you knew Spanish.
Actually, I should.
Yeah, only when you're talking to the maids at Caesar's Palace. Okay. Anyways, do you think? Oh, this is very relevant. On the plane on the way home, we sat next to this fellow, an older guy, but he was a sharp guy. But did he have a lot of theories about big money and all these computers hooked into the NYSE, the high frequency trading programs and computers that they have hooked up at the NYSE, I guess, and that he says the whole market is rigged and the whole market is manipulated, and it's pointless to try and deal with it. So, Dr. Kidd, do you think high-frequency trading can manipulate the market? I think it definitly can.
It certainly does. On a day trading level, it certainly does. It's knocked out a lot of day traders from trading because, on a short-term level, I think it adds so much noise and confusion that a lot of day traders can't get their heads around it. On a longer-term level, on a trend-following level, there's still no evidence that HFT makes really much of a difference, because HFT's been around, for a number of years, and if it did make a difference, then we would not have been able to perform, as we did in 2009, 2010, 2011. And 2011, as trendless as it was, there were still periods where you could catch a right trend. And 2012 being so challenging, I don't think has so much to do with HFTs as it just does with that. There's so many cross currents going on right now, and there is QE manipulation, and I think the manipulative tendencies tend to outweigh the direction of the market. So the market finds itself kind of in a schizophrenic situation.
I think the charts show you can see the TYH here, that you can see that this is underperforming the NASDAQ. This is the QLD is the inverse Qs, and you can just see on the chart that the TYH. Oh, what the heck was that all about? Let's see. Here we go. Beep beep beep. That's the clown car coming around. You can see that TYH has been considerably weaker, and it actually broke its support level several days ago. And so this is a lot weaker, and I think it's probably related also to the weakness in technology and cloud stocks and Apple. This is a technology bull.
Right. Russell 1000 technology.
That's a bull? Isn't that a bear? No, that's a bull.
TYP is the 3X.
Yeah, I'm looking at that to represent the market. O'Neill has written about pyramiding and has certain techniques. Can you elaborate on your methodology when buying ETFs?
Actually, the other thing also on these 3 times ETFs is when you get a downtrend or an uptrend, they tend to exaggerate it because they're leveraged. So you could get the benefit of being in a leveraged ETF when you're in a trend. Of course, the converse, when you're not in a trend, if you're in a trendless environment, then these leveraged ETFs will underperform.
O'Neill has written about pyramiding and has certain techniques. Can you elaborate on your methodology when buying ETFs? We don't really have a methodology for pyramiding ETFs. I discussed it a little bit earlier, that what we will do is choose a certain percentage, depending on the velocity of the ETF, and its volatility, and determine that every 10% we're up on the position, we'll add again the same number of shares. So in fact, we're adding a little bit more percentage-wise each time because it's a higher price, and we build it that way. That's our methodology. We don't use continuation pocket pivots like we would with a stock, so there's really nothing really to elaborate other than that. That's how we do it, and it's not rocket science. That's really all it is. Somebody asks about the publication date of the new book, summertime, end of summer, just like the last one. Is EDZ a good ETF for the European situation?
Yeah, it's excellent. I mean, that's why we've recommended on the short side, rather on a sell signal. Global emerging markets tend to be the weakest performing markets when Europe is weak, when the rest of the world is weak. Those markets, emerging markets, get hit very hard, and vice versa. When things are strong, those emerging markets tend to outperform. So right now, with things being so weak over in Europe, I think EDZ is a good ETF to be involved with, and certainly with the last sell signal by the model, we did make a recommendation on EDZ.
And yeah, and that did that right. Yeah, that's moving up high. Somebody asks about UVXY. What's the inverse of UVXY?
There is no 2x inverse.
So here's a good question for you.
You have the 2x TVIX and UVXY. You do have a 1x inverse, which is I think that's XIV.
Why hasn't the UVXY model gone onto a buy signal?
Yeah, good question. It's sitting. That's a great question because we were just discussing this.
I'm watching Apple starting to come down hard.
So you have the model which should be on a buy signal because the MDM's on a sell signal. However, the model's short term. It's very volatile, and it's looking for that short-term edge. It hasn't found it, surprisingly, because there's so much cross currents. What I mean by that is, for instance, when the markets hit that 2,900 level, it tends to rally. It finally goes through the 2,900 level yesterday, and instead of breaking down, it actually finds its footing and rallies, and then the market was rallied today. So with all that said, let's just say that the UVXY model is very close to switching out of its neutral position because it is looking for that edge, and my guess is that the model tends to trade fairly frequently, so that edge is going to come sooner than later. And typically, on the back tests, the UVXY model tends to trade at least twice as much as the MDM, so that's quite a bit. And it's designed to catch the short-term moves in the market, and if the market does trend, however, it will catch those trends, the long-term trends. So on a sell signal issued by the model, that means short UVXY. When the market goes in an uptrend, like it did early this year, the UVXY goes in a downtrend, in a very organized downtrend. So on a short position, you can do quite well. And that's that test signal that came out early this year was very profitable, to the tune of 71%. But again, I want to see this done in real time. I expect it to see at some point, a trend. The model catch the trend, and the short signal on UVXY will be profitable.
I think when we were at dinner one night at Caesar's Palace this week, you mentioned something that on the back test, that if you had this in 2011, you could have been up 2,000%.
Right. It was over a period of about 1 year's time. And the backtest showed over a 2,000% return over that year. And that was also, keep in mind, that was without any fail-safes, so the worst signal actually was quite, in one signal there was a 38% loss. So keep in mind that there was incredible volatility to get to that 2,000%. So now we have a fail-safe at 19%, which on a money management perspective, it actually makes sense, but it also makes sense based on the data. That's how I came to the 19%. Yeah. But basically, if you put 10% of your account in UVXY and it goes against you 19%, that's only going to cost your account 1.9%, and some people might want to do, heavier, maybe 20%. But I would generally not recommend going in any deeper than 20% on your personal account with these ETFs. It's just absolutely crazy and volatile. So, and also be aware that when the market gaps up or gaps down, UVXY will do the same, and it will do it ferociously. So always keep that in mind.
Somebody asked if you're already long the UVXY, should you just hold it? Yeah, I guess that's up to you. Remember this morning it was down. I saw it down about 75 cents, which is about 5% this morning when the market was rallying up 80-something points. And I thought at that point it's probably viable. So, you can hold it, but it's no guarantee that it's going higher, and you're not running on a buy signal on that model right now.
It's a cash signal, but I would say on a money management perspective, if you're sitting on it and the market, we are in a downtrend, so I would say hold on to your position, but keep your stops tight so you don't give back much profit.
Yeah.
And the other thing is, if the model goes to a rather a buy signal, say tomorrow or later today, I'm not going to be very surprised because it's looking for the edge, and that edge can come all of a sudden.
Somebody asked for ETFs, what moving average are used for entry and exits? We don't use moving averages for entry and exits, so we use signals on the MDM. Let's see. I'm going to go through some more stocks here people are looking at. Somebody says INVN, there's some news that their chip orders or their chip supplies are doing better, and does that mean you should watch for something in the stock? I don't think there's anything to watch for in this stock. That pattern is so damn ugly that it's going to take a lot of time to heal and set up properly. So I wouldn't touch it with a 10-foot pole. I don't care what the news is. Open table, I think, is a short, and in this rally here, you're rallying up to this resistance level here. Here comes a 50-day, and here comes all the other moving averages as well. You get the 20, you get the 65-day exponential up here, you get the 10-day here. But I think up in this level, you're coming right up into resistance. That's probably shortable. It hasn't broken down, oddly enough, but this is another one I tried to short and couldn't borrow. So I don't know if anybody else out there is able to get a borrow on these things. So. I'm looking at Haynes. Somebody wants to look at. Let's see. I'm just looking through these questions. And Haynes is acting fine, but I'm not sure what I'm supposed to tell you about it. I mean, I think you're using the 50-day moving average as your guide to sell it, but that's way below it. So you're going to have to decide whether you want to lock a profit in. But other than that, the stock is just holding up, and that's about it. Somebody's asking, is it okay to buy PCYC on a day like today? I looked at this. We looked at this yesterday, didn't we? And
yeah, we did.
Somebody, there's a couple of pocket pivots in here. It's a biotech with no earnings, so it's all speculative type stuff. And like we said, we're not buying anything in this market.
Yeah. Speaking of which, did you over the there was a thin biotech that one member wanted to know about?
Which one was that?
I'll get the ticker. Send an email over.
I think that was it, wasn't it?
No,
somebody was asking about. Okay, Yuri. Somebody want to know, is Yuri shortable? It might have been, but it's not really one I would focus on. Not really a big stock. Let's see what else. EWP. Someone's asking about. That's an ETF, isn't it? EWP.
That sounds like an ETF.
Yeah. So I don't know what's up there. I mean, it's just going down.
Spanish. It's Spain.
Yeah, so I don't really know. Is that a short, or would you take profit? I don't know. What is your objective for the trade? I think I can't tell you. That thing's just going down. That's all it looks like.
Spain's really weak
for now. So, Dean Foods, not sure what you want me to tell you on that one either, other than the fact that you had a viable gap up, but it's just holding up and staying up. So I can't tell you whether you should sell it because I don't see any action that tells you it's a sell yet. Not that, and I certainly wouldn't be buying it in this environment. Of course, there is no buy point either. So. It's just kind of in a position where there is no real signal in terms of taking action. So you can't. Well, I don't have a crystal ball, so I can't really tell you what should be happening. Somebody asks, would you get out of Monster ahead of an expected downturn or wait for a violation? It depends on whether you think that if you expect a downturn, it's going to happen or not. It's up to you on what you want to do. If you see the market getting really ugly, you might just want to lock your profits in and bag it. That's really the bottom line. There is no absolute when it comes to taking profits when you have a stock that is acting very well while the market is getting hacked and whacked. So let's see. Last one here.
It was THLD. That was it.
Okay, I'll get to that. Bed Bath and Beyond. What is Beyond the bed and the bath. I don't really know. But in any case, what about it? I don't know. It's trying to come up. It's kind of a choppy double bottom. So I'm not a buyer. If you're asking for advice whether you should sell it, that's kind of up to you. You know, what is your objective for the trade? What is your stop? Do you want to hold stocks in a deteriorating general market environment? If they're acting well, they may continue to just go sideways. So you kind of have to decide what you're going to do. There's no magic answer here. Let's see. Looking at some other questions here. Oracle as a short. I don't really look at it as a short here. You know, it's kind of pretty well played out. It probably goes lower if the market goes lower. So, and I'm watching Apple trade here, and it's actually keeps just plummeting to newer lows. Yesterday was pretty funny because the Apple was sitting up right around the 65-day exponential in the morning. We were doing a presentation on market context, and I started talking about Apple as providing a context for the market continuing to weaken. Since it has been the big stock leader along with Priceline, if it continues to weaken, I told everyone that I would expect the market to continue to weaken. And lo and behold, just as I said that, Apple started to break down and drop below its 555 level in a hurry. And that was pretty funny that it started to break down right at that very moment. So almost looking like I told the market to do that. But I do think that this doesn't really bode well for the market. And you know what? I wouldn't put it past the stock that, you know, maybe it's topped for good because everybody loves it. $1,000 price target just seems kind of bizarre to me. And everybody seems to just be very complacent and, you know, everything's fine. CMG, if you were using the 10-day moving average as your selling guide, which you would have been, because you close under here but you never go below this low. You close here but you never go below that low. You close here but you never go below that low. So here you violated the 10-day moving average, you're gone. That's the bottom line there. And now you have violated the 50-day moving average. Now you really better be gone. And doesn't this remind you very much of Apple bouncing here and then hanging along the 65-day exponential and then blowing down to the downside over the last 3 days? And CMG now in a similar position. Could it be a short? It could be. And it could probably undercut this low here. So that's a possible. But I would call that a tactical short. And what I mean by a tactical short is something that you're going to day trade or trade over the course of 2 or 3 days short term. Or you know, trying to play a move of that duration. It's not clear to me that it's necessarily going to go boom down to the downside right away, but it could eventually get to the 200-day moving average in a real hairy market environment. That's a possibility, but I think it's definitely a former leader that is breaking down, and it needs to be monitored, and it should be on your short selling list. Let's see. Let's do some more questions. I think we're somebody's bringing up some racks here. Rack seems to be holding up better than other cloud stocks. Today it is, but you have to remember it's also blown apart last week. I think it's shortable right here. So, and in fact, I'm shorted right at 65-day exponential. Notice how it's rallying up into it, and I'll decide whether I'm going to hold this thing because it is holding up, but I still think this thing eventually goes lower. So that's kind of the bottom line for me, and I'm not really too concerned. I set a stop here and somewhere up here, and if I'm on my jet tomorrow and I don't really want to bother with the market, if it gets stopped out, I'll let it get stopped out there. But to me, it looks like a short here. You have a late-stage breakout failure or just a breakout failure that has gapped down, and the stock, you know, back here it gapped down and it got support by closing at the highs of the day on the trading range, the intraday trading range. But it did the same thing here. But you got a sharp rally here. This is not really showing any real juice, and it's been stalling up around in here yesterday and today, and I think this thing's got some problems. So I think it's going to roll over. I think it's headed for the 200-day as well. But yeah, it's stronger today, but it's been weaker before, and this is a really nice 20% blow to the downside. Okay, so this thing blows 20%. So really, on a relative basis, F5 is only off its high by 14%. Rax is no, is that right? What am I saying? Yeah, that's about a 20% move. So in order for this should have to be a 26-point move. Yeah, it's not really weaker in terms of the general move. Today it's stronger than the other clouds, but you know, you're getting to a point here where F5, like I said, you probably want to be covering that. But I still think that's in play, and I think that's a short right there. If it gets to the 65-day exponential, then maybe you're going to the 50 days. So So should it play catch up? I think it probably will, and then probably play catch up to the rest of the market. SOX S3X semiconductor short. I've liked this before. I think it's probably viable. It's breaking out, but I'd probably like to buy these on weakness. Just like I prefer to buy the UVXY. Like this morning is a perfect spot. Down 75 cents. The Dow's up 85 points because Merkel and Holland cooed at each other, and then housing starts or something were a little better than expected. You know, I would point out something. We get a lot of questions about housing stocks. You know, are they the new leadership? Well, when you look at a daily chart with a short timeline, you're back to November of last year. That looks really great. You know, breakout from a base here and holding up really tight. But when you look at these things on a long-term basis, you're going to watch this guy draw. I mean, this is where you're at. So I don't really know if you really formed a bottom and you're ready to go higher. So I think I tend to look at the housing stocks rallying as maybe being the dogs barking. That's more how I look at it. I think I don't really think there's some big move and they're all heading up and housing is going to magically recover because it isn't recovering. And it's not going to get back to the levels it did prior to 2008.
Yeah, when these bubbles burst, it takes a lot of years of healing time. People probably remember 1988 to 89. That whole 80s bubble popped pretty viciously, and a lot of properties I remember in Beverly Hills, Palos Verdes, you know, all across Southern California, nice properties lost half or more of their value. And it wasn't until I think it was 1993, so we're talking 4 or 5 years later, that things started to gain traction again. And then it was a slow growing period, and it wasn't until I guess 1998, 99, 2000 that things started to really take off.
I'm looking for a couple other questions that we had. Oh, yeah, this is a good question. Well, I don't know if it's a good question, but I think it's probably something I should cover because I think whoever's the person asking this question does not understand what a 3 weeks tight pattern is. So let's give everybody a quiz here. Is that a 3 weeks tight pattern? Nobody answering? Everybody fell asleep on me. No, it's not. I mean, I see what they're saying. They see it closing 3 weeks tight, but that's not a 3 weeks tight pattern. You'd want to see that the reverse. To me, this almost looks like a inverted bear flag and a failed sort of breakout from this ascending type of flag here. But that's not a 3 weeks tight pattern. What you would want to see is 3 weeks tight. It's more like let's see where you might say this in here is more like 3 weeks tight in here, but it actually goes for a period of time, another 5 weeks. 5 weeks on this base before it breaks out again. But you'd expect it to look like this, not like this, okay? So that goes down hard and then it holds tight. So that's not 3 weeks tight. That's the inverse of 3 weeks tight. So, and I think that's all the questions we have. I mean, obviously there isn't a heck of a lot going on. There's a handful of short sales ideas to campaign that we talked about last week, so you already had to be dealing with those last week, I think. I think right now you're getting to a point where you could get a little snapback, and like I said, watch for the Facebook IPO. That could engender some sort of in the general market that could be shortable, and so that's what I'm watching. My plan is probably today or tomorrow morning take profits in my short sale positions, and then hang out tomorrow and just fly out to Rhode Island and then check things out on Friday because I think it'll be a better setup on Friday. But I could be wrong. I mean, unless this is going to be like August of last year when the market blows to pieces here very quickly. But it doesn't really look like it. It kind of looks like you're in something like this
Right.
kind of soup here. And you might need
back in
another back in here. So you're going to come down so far and then you may get a break later on.
Because also August was that drop was due to a confluence of negative events, namely the downgrade of U.S. Treasuries by the S&P, and then also Bernanke, the Fed, basically being very staunch about, hey, there's no more QE, and I think that that's put some shock into the markets.
definitely. So right now it seems like you're in this rolling kind of top, and it's just developing, and right here you're in position to rally. Let's see, and that's pretty much our view right now. So we're not really hot on the long side, and like you said, if you have profits, nice profits in a leading stock, and it's holding up, you can make the decision to hold on to it if you think it's going to continue to act well, and you don't want to book a profit to pay taxes. But that's neither here nor there as far as I'm concerned. But it's really up to you in terms of what your objective is for the trade and what you're trying to achieve, and whether or not you're willing to sit through a general market correction that could continue to get ugly. But I think you're probably in a volatile, choppy period for a little while as this top develops, assuming it continues to, and it looks like it is, and it looks like things are getting worse. And the guy, when we were talking to this fellow on the plane, he said something about we're headed for anarchy, and by the end of the year it's going to happen. He was pretty opinionated.
Yeah.
But nice guy. It was fun talking to him because you rarely run into somebody like that on a plane, especially going to L.A., which is the land of the liberals, or actually the land of proletarian chic. So we like to pretend we're proletarian, but we drive Mercedes and live in big houses on the California coast. But we like to pretend we're in sympathy with the working class. But as the great Uncle Duke from the comics of Doonesbury said, the best way to avoid being part of the working class is to be sensitive to it. And I think that's what most of these limousine liberals, proletarian chic types do. In any case, so it was fun to meet somebody like that. A little bit extreme in some cases, thinking the markets are completely manipulated, and I would say they are at least partially. And on any given day, they could be more than partially. And it's the end of the world coming at the end of 2012. Are we headed for anarchy? Maybe we're headed for dictatorships. Who knows? But the market is discounting something, and I'm not sure if that's the end of the world or not. But I hear they discovered a new portion of the Mayan calendar which shows something else. In any case, that's all we got, you guys. Thanks for listening. And it is 12:32, so you've been here for an hour, and we got to catch your breath. We just got in from Las Vegas. We had a great time, and all those of you who are on the webinar and that we met, thanks for coming out, and it was a great pleasure to meet you all.
It's great. A lot of fun as always.
And really gratifying to see that some people are actually doing pretty well, and they're doing better than we are. And the way we look at it, if we have a period of time in the markets where we're not really hitting it right, it still doesn't mean that we can't impart knowledge and ideas and even talk about our mistakes so that you guys can learn from them, and that you come up with a completely different and much, much improved result. And we like to see that. It's fun to see. I got to say, I really enjoyed that. Yeah. So anyways, take care, and we'll catch you all next week when I get back from Rhode Island, and you're going to be where, in Cannes?
I'm going to be in Cannes.
Having, what, on business? No.
Well, yeah, that's the whole
Yeah, pleasurable business or business-like
It's going to be fun. I mean,
okay.
it's like St. Bart's was a lot of fun.
Yeah, rough life, Dr. K. All right, you guys, take care. We'll catch you later.
Take care,
Ciao.
everyone.